So hello everyone guys, and today we are gonna talk about support and resistance levels in technical analysis and why it doesn't work and how to rate it perfectly by using smart money concept. So what is support and resistance? Support and resistance are key technical analysis concepts representing price floors and ceilings, where the market frequently pauses or reverses due to supply and demand. Traders use these zones to find optimal entry and exit points. So the most famous ways of trading resistance and support levels is waiting for breakout and reversal of the price. So how this works in the technical analysis logic? Let's remove anything like that, move it like that, man. So what we can see on this chart, support and resistance levels is the highest point in our sideways movement where the liquidity are collected. So for example, it is here because the price didn't break it like that. It's didn't collect all the liquidity and it doesn't move like that. So it is our resistance levels and support level. Resistance on the top, support on the bottom. So what's the logic? The technical analysis waiting for break of the resistance levels for the capturing of liquidity, and after that where logic what if the price break this point, this will break the support level or come to it. But often the scenario are going to look like that. Price accumulate here and after that breaks this liquidity and the movement are changing and you don't get a good deal. So the deal by the technical analysis concept are looking like that. We are rating from the capturing of this point with the random stop loss. Here you can place it logically, all of them place it just higher than resistance levels, and it is very bad for the risk reward ratio. I told you about that in the previous videos. And the take profit like that on the bottom level to the support, not breaking of liquidity. And one more thing why it doesn't work, because liquidity pools are the main concept of smart money. Yes, we are looking for them, we are waiting for they are captured, but the other factors to enter the deal is our optimal trading entry points, our point of interest. So it is the FUG, order blocks, and our places where we can find very good deal entry. But this technical analysis strategy doesn't give us any good point of entry, because entering of capturing of liquidities, we don't have a good entry point, good stop loss, good pick out point, and we can't enter like that. And of course you are not lucky enough to see when the smart capital are going to grab all the liquidity of retail traders. They are smarter than you in any way, you can overplay them. So here traders are waiting for their deals where placed our limit order, and here we replaced the limit order. Here you can predict in which way the price are going to grab the liquidity, for example like that or like that, and how to enter. Yes, you can place a deal here, and wait for the capturing of them, but nothing give you a chance what the price are not going to move like that or like that or like that and hit your stop loss. For that we are using our smart money concept. Okay, here we can see our sideways movement. We can define the liquidity pools which are not grabbed, not captured, and what we need to do in this case. We need to check the movement what are prevented our resistance and define our optimal trading entry point, our point of interest. For example, here are the FUG situated. Here we can see an uptrend movement, it doesn't break, the structure doesn't break. So, and what we can think here, we have a huge liquidity pool which are not grabbed, and the price of course are going to capture it. And what we need to do, here we see our zone. For example, here are our FUG plays, and we are looking for deal. We have uptrend movement, we don't see any factors to open the deal on the breaking of this liquidity, not any factors, we are not looking at that. So we cut down our unsuccessful deal. It's 99% of it is gonna be unsuccessful or with bad risk management. So we are waiting for the entering a long deal. We can see our zone. The first confirmation of entering the deal is our FUG. The second is huge liquidity pool which are formed here, and after that we just place our long deal like that and take profit. Entering the deal from the FUG and take profit on the liquidity levels. So it is best perform we can make. And the price, I'm gonna grab this liquidity because the price all grabs the liquidity. There are no situation where it's not gonna grab all this liquidity pool. It is can return in 10,000 years after, but it is gonna grab it and fulfill fill this PVG. And for confirming of our deal, we can place our Fibonacci grid. It is better to make it like that, so we can see our optimal trading entry point on this scheme and enter the deal from that. We are in discount market. With the discount market, the smart money are going to buy the deal and the price are gonna up and we get a successful deal. And in the short movement, it is gonna look like that. You can make a screenshot. So what we need to see for the entry of the deal? The FUG, our point of interest, our Fibonacci grid, where the place our premium discount market zone and optimal trading entry point. After that, defining our top loss and take profit. Move to the lower time frame, find further hour confirmation, and only after that you can enter the deal. So now let's move to the real chart examples where I'm going to show you how to trade there. So now I'm going to show you one example why the default technical analysis doesn't work in these situations. So what we can see here, our sideways movement forward, for example, here and here. It is 4-hour time frame. So I think it is a good example because price formed our support level and resistance levels. But what happened? The price, for example, what are typical technical analysis person are going to do? Here seeing this situation, capturing of liquidity and what opens a short position. Here are two situations. He can place the short stop loss and here are going to be liquidated, or save stop loss and place it, for example, like that. On this liquidity. Not on this, it is gonna be more risky. Here, what happened? The price didn't get that, but it tests the order block here, formed order block here, and after that, reversed from that. So what the smart money user are going to trade with it? We are not always trading by trend, but if you are opening safe deal with the 100% informative, why not? So let's define our PVGs. Here we can see one PVG from which we can enter a very good deal. For example, like that, meanings with stop loss, I don't know, like that. And where we are going to place our take profit. The most safest way with a good risk reward ratio is this point or this point, or if you are not lucky enough, you can place it like that. And of course the Fibonacci tool. So in every way where you open the deal, here you can fix, for example, 1 to 3 risk reward ratio on the 50%, and after that just fix it by part. For example, here 80%. After that you moved your stop loss to the zero loss point, and after that you're in profit. So here we are, if we are going to trade long meanings, we need the price to break this liquidity pool here. It is, I can tell, it is grabbed all the liquidity and price grabbed it only after that. So I think grabbing of this liquidity pool are a good signal to the growth, because the smart money we are grab liquidity for power or strength of movement. They can't just push price to the top where we need liquidity, and forcing and grabbing this liquidity point are very good sign to reverse the deal. For example, you can open the 1 hour time frame, and after grabbing of this liquidity or this means you can open a very good deal on 10%. So for example, here we can see sideways movement, but what we can see here, after the price break this liquidity pool, it doesn't reverse, it grabs the higher liquidity and only after that go down. So the perfect way to trade the sideways movement, you need to define it. We can place the price point to the lowest, for example, like that, and after that you are defined your PVG zone and you are waiting. If the price grab this liquidity first, you don't do anything, it's a losing game. But if the price break this liquidity first, fulfilling this PVG, you already can enter the deal from the 50% of this PVG with a conservative stop loss and take profit on grabbing of this liquidity and grab a very good deal. And we can place our Fibonacci grid and define our optimal trading entry point. So it is a trick how to define the better PVG from which you can enter. So let's watch to the narrow sideways movement, which I found here. We are going to define it by the Fibonacci grid tool, like that. This drop grabbed all the liquidity on the bottom here, and what we are waiting, the downtrend movement, and we are waiting for the downtrend deal. And we can take our short position to define our VVG from which we can enter, like that. And we are waiting for grabbing with liquidity. We don't see gaps like that, it is deviation. We place conservative stop loss on the entered from the VVG, waiting for the grabbing of this liquidity and get a very good deal. So if you want more about support and resistance levels and how to trade the sideways movement more deep, I'm going to record new videos, but you need to drop your comments, set likes and follow my Telegram channel where I'm going to drop all the trading materials from the videos. Goodbye.